Swing trading in 2 minutes. Let's start. Aims is to capture short to medium-term gains in a stock or other financial instrument. Unlike day trading, which involves making multiple trades in a single day, swing trading involves holding positions for several days or even weeks. The goal of swing trading is to identify and capitalize on short-term market trends with the aim of making a profit when the price swings. One of the key strategies in swing trading is technical analysis. This involves studying past price movements and using various technical indicators to identify potential entry and exit points. Traders often look for chart patterns, such as head and shoulders, double tops and double bottoms, to signal potential trend reversals. Additionally, they may use indicators such as moving averages, relative strength index, RSI, and stochastic oscillators to gauge the strength of a trend and determine when to enter or exit a trade. Another important strategy in swing trading is to set clear risk management rules. Traders should always define their stop loss and target levels before entering a trade. This helps to manage risk and protect capital in case the trade goes against expectations. Additionally, traders may use trailing stop loss orders to protect profits and minimize losses as the trade moves in their favor. Furthermore, traders often monitor for catalyst events that can cause significant price swings. This may include earnings reports, economic data releases, or geopolitical events. By staying informed about these events, swing traders can anticipate potential market movements and position themselves accordingly. In conclusion, swing trading is a strategy that aims to profit from short to medium-term market trends. By using technical analysis, setting clear risk management rules, and monitoring catalyst events, swing traders seek to capitalize on price swings and make profits in the financial markets. Thanks for watching. Please follow for more.